And I see people are being added, so I'll wait a few more seconds. Okay, let's go ahead and get started. Hello, everyone. My name is Mariana. I'm the Scholarship Director for Mentorship for an Accessible Prize. Before we jump into the presentation today, I want to give a brief overview of our organization. So Mentorship for an Accessible Prize is a graduate student organization dedicated to fostering accessibility and support for prospective and current students at the Sol Price School of Public Policy. Through structured mentorship, MAP connects prospective students with current Price mentors to provide guidance, insights, and resources throughout the graduate school application process and the student experience. And I may have seen some of you at our events during Admitted Students Day last week. We hosted a mixer, we hosted many other presentations, and today we have an excellent presentation by Megan McGuire from the Student Loan Planner. So Megan, thank you so much for being here, and feel free to start whenever. And oh, one last thing, if everyone can please ask their questions in the Q&A box, we'll go ahead and ask them throughout the presentation. Thank you.
Awesome. Well, thank you. Yep. And I'm Megan McGuire. I am a student loan nerd. So we're going to be talking about student loans and student loan repayment this year and beyond, kind of what to expect. The student loan system has been kind of rocked over the past year, 2 years. So we'll talk about some of the changes, how they might be applicable to you, and help you make good decisions with your student loan situation. So we're in a good financial position. So who are we? Well, student loan planner, we're specifically specialized in student loan planning. So we're all financial planners of some kind. So certified financial planners, certified financial analysts, but all have the designation CSLP, which stands for Certified Student Loan Professional. We've advised over 19,000 people. I think so far today, and that's about 4.2 billion in school debt that we've advised on, with a projected 1.3 billion in savings. And our goal really for helping folks through Student Loan Planner is helping people save money on their student loan plan one way or another. So that could mean by helping you put together a plan that helps them pay off the loans faster to reduce interest cost over time. Or that could mean just getting on the right plan in the first place, which could mean loan forgiveness. Public service loan forgiveness is a really great program available to folks working in government or in public service, nonprofits. So, really helping folks navigate those different programs and save the most money on their payments and on the overall plan. Let's talk first. Let's jump into just talking about a general rule of thumb for how to treat your student loans. If you are eligible for PSLF, that means you're working in a government capacity, or you will be, or a nonprofit capacity in the future. Take these a little bit with a grain of salt because the math might be a little different. But the general rule of thumb for how to treat your student loans is if your balance is a lot less than your annual income. Let's say that you make 60,000, your student loan balance is 20,000, then you probably want to be treating those loans a little more aggressively and paying those off sooner rather than later. Mathematically, we may not reach a forgiveness threshold if our income is quite high in comparison to our balance. Now the reverse is true though. They're basically flip this on top of itself if our balance is a lot greater than our annual income. So let's say we make 60,000, but our student loan balance is 150 or 200. That tells me that we're not going to have we could take a more aggressive approach, but we could really benefit from the programs in the student loan system that provide loan forgiveness. And that's by making payments based on income until a specific threshold of time is reached. If we're doing PSLF, that's 10 years. If we're not doing PSLF, that's either 20 or 25 years, which I know the longer time frame, it does sound quite long, but if our balance is a lot greater than our income, paying it off more traditionally may take that long anyways. So, the let's see. Now, if we're kind of in between, let's say our balance is about the same as our income, or close, not quite two times our income. We're kind of in this it depends scenario. And this could mean that PSLF could make a lot of sense, public service loan forgiveness, if we're working in that capacity. Because if your income is about the same as your balance, but we're doing PSLF, you have a shorter timeline to make that repayment plan make sense, because our payments have to be based on income, and that may be short enough of a time period where we end up getting loan forgiveness at the end of that 10-year term. So it comes down to the math. That's why I say it depends if you're in this bucket. But this might be a good starting point to see, okay, well, if my balance is a lot lower than how much I make, I'm probably going to end up paying the loans off. But if that's not the case, if my balance is close to my income or greater than my income, I might want to pause and just check to see if those income driven plans or those forgiveness plans make sense for me before making a final decision on my overall loan plan. I talked a lot about income driven repayment plans. So let's break that down a little bit further. Income driven repayment, IDR. There have been 4 income driven plans, and you may have heard of these names before. There have been some changes, though. So let's talk about those changes over the past year that might affect what we have access to. So we did have this SAVE plan that came out. I'm going to kind of go backwards in order. This SAVE plan was announced a year and a half ago, maybe a little longer now. And it was meant to replace what we used to have that was called REPAY, Revised Pay As You Earn. This was one of the cheapest income driven plans. And then SAVE was going to be even cheaper from a monthly payment perspective. The payment was going to range between 5 to 10% of your discretionary income for its calculation on what the payment would be for you. And the undergrad portion would be based on 5%. Your graduate loan portion would be based on 10%. And depending on how big the balance was, that would dictate how many years we'd have to pay on that plan until we got to loan forgiveness, with or without PSLF. PSLF is always going to be 10 years. But if we were looking at SAVE for the longer term forgiveness timeline, it was going to be between 10 or 25. This plan has been highly scrutinized. Anybody who is on this plan currently, they've been put into this payment forbearance where they're not able to make payments right now because Congress is trying to decide if they want to keep this plan around or not, if they want to go ahead and shut it down. How can that happen? Well, SAVE was brought about by an executive order, which means the president at the time decided, I want to implement this plan. And that's what he did. He went ahead and implemented this plan by an executive order, his own action. It was not brought about through a legislative process or a legal process. So the plans that were brought about legally or through a legislative process was old IBR and new IBR. So technically it's the same plan. IBR is all you would need to apply for, but there's a different calculation to the payment depending on when you borrowed your student loans. So old IBR, this is based on 15% of discretionary income. Anyone has access to this plan, but if you borrowed after July 2014, we have access to new IBR. So if you were a brand new borrower as of July 2014, we have access to new IBR, and that payment calculation is 10%. So that's really close to what SAVE was going to be from a payment calculation. And what's nice to know about IBR is that it is legislative. It was written into the law, so it cannot change. If we were to apply for that plan, we won't have to worry about it being ripped out from underneath us like the SAVE plan. Pay was brought about by an executive action as well. This was brought about by Obama, actually, back in I think it was 2016 or so. So pay works exactly the same as new IBR, but we could be eligible for pay as long as we didn't have a loan outstanding before October 2007. So there's two dates here. Pay, we could be eligible for this plan if we were a new borrower as of October 2007. We didn't have any loans before then. New IBR, we could be eligible for this plan specifically if we did not have any loans outstanding before July 2014. So two dates. But both essentially are the same exact plan, 10% of discretionary income. And if we're not doing PSLF, the forgiveness threshold is 20 years. Old IBR is 15%. So if we borrowed in 2002 or 2003, maybe for a different degree or something, we are not going to have access to new IBR or to pay. So our option here is old IBR, which is based on 15% of discretionary income. And then lastly, we have this ICR plan, income contingent repayment. I rarely recommend this plan. It's one of the oldest income driven plans that came out. It's based on 20% of discretionary income. So not very attractive compared to these other options. But what has happened is we used to have all four of these available. Now we're not able to apply for this SAVE plan right now until they decide what they want to do with it. And we're not sure. We're still waiting on kind of the court response on if they're going to take this plan away or not. And pay, new IBR, old IBR, and ICR, they remain open for you to be able to apply for currently. So if you're not already on an income driven plan, you could apply for those plans here, those three plans here. I do see a question in the chat I can answer real quick. So the question is, how do you figure out which plan you are enrolled in? The easiest way I would say is log into the studentaid.gov website, studentaid.gov. That is going to take you to your dashboard and you can see your loan details. If you keep clicking into your loan details, it will take you to where it will show you what repayment plan you're enrolled in. If it says save, saving on a valuable education, that's what that stands for, then you are likely in the save forbearance where you are not required to make payments right now. The positive to that is interest is at 0% if that's what you're in, the save forbearance. But the downside to that is that it is not counting towards loan forgiveness. So the time that we spend in forbearance where we're not making payments, it's not counting towards PSLF or towards the longer term forgiveness. So it might make sense to switch to a different plan if you're in that environment, if you're wanting to get as much credit towards forgiveness as possible. All right. So that's a breakdown of the income driven plans. Let's spend some time talking about PSLF because I know that could be super relevant to a lot of folks here. So PSLF or Public Service Loan Forgiveness, this is not a repayment plan. This is a forgiveness program that has 4 requirements that we have to check the boxes off for to be eligible for the loan forgiveness. So the first eligibility requirement for this is we have to work full-time at an eligible employer. So full-time, they consider that at least 30 hours on average a week at an eligible employer. So that's any government entity, so federal, state, local, tribal, city, anything in government, or any 501c3 entity. This is a nonprofit tax exempt status. So 501c3. You can confirm if an employer is eligible by grabbing their EIN number, which is their employer identification number. It's kind of like the business's social security number in a way. It's public information though. And you can look that up on the studentaid.gov website, which you plug in that EIN number, it'll run it through the system and it'll tell you if that employer is eligible or not. So that's a surefire way to check to make sure that your employer is eligible. We have to have direct loans. So private loans, privately held loans are not going to qualify for PSLF. Only loans that you borrowed through the Department of Education, the studentaid.gov website will list the federal direct loans that you have. So this is usually what you're initially offered to go to school for undergrad or for graduate school. Undergrad, you do have small loan limits where you can only borrow up to a certain amount for your undergrad degree. So it's possible that if that amount for the federal loans wasn't enough to cover your undergrad education, it's possible you could have some private loans or what's called parent plus loans that your parents borrowed for you. Those are not going to be eligible for your PSLF, the private or the parent plus loans. But your federal loans, and if you went to grad school and you have graduate school loans, you can borrow up to the cost of attendance and graduate school loans from the federal system. All of those are going to be eligible for PSLF. Another requirement is we have to be on the income driven repayment plan, IDR. So that's one of the ones we just talked about over here, except for SAVE. So SAVE was eligible, but right now it is not being considered eligible because it's caught up in this court process. We need to make, and lastly, we need to make 120 qualifying monthly payments. And a qualifying payment is one where we've made it while working full time at an eligible employer. We paid on our federal direct loan on an income driven plan. So if we check those three boxes all at the same time, that payment is going to be qualified for PSLF, and we need 120 of them. Oops, went too far. We need 120 of them to get whatever balance is left at that time forgiven. And so the balance that gets forgiven, there's no limit on how much can get forgiven. There's no income limit on being able to get PSLF. It's as long as we check these boxes, we make those income driven payments over the 120 months, whatever balance is left over at the end of that timeline is then forgiven. And the balance that's forgiven is tax free. So that just means that we're done. Once that balance is forgiven through PSLF, there's no tax consequence for the forgiven debt. That is different for the longer term forgiveness. If we do the long term forgiveness, where we get loans forgiven after 20 or 25 years, then that could be taxable. We'll talk about that here in a second. And then a big question I'm getting right now is PSLF under scrutiny? Is this going to change? And the answer is no, not at this time. And the good news here is PSLF, just like IBR, this income-based repayment plan, was brought about by a legislative process. It was written into the law. So it is not simple for Congress or government to come in and just do what they want here. It's a law that they would have to amend and go through a legislative process to change. So we don't see we're not seeing anything like at risk with PSLF right now, thankfully. But that is a common question I'm getting. I'm going to go check out the Q&A. So yes, a couple questions. Do graduate plus loans count towards PSLF? Yes, they do, thankfully. Graduate plus loans do. Let's see. If I attend a PhD program and I make payments while in that program, does it count? So this is a great question because this happens a lot. So if you're in a PhD program and you're borrowing loans for that PhD program, the loans that you're borrowing are not going to be eligible to be in repayment if they're unsubsidized loans. The graduate plus loans, if you're borrowing graduate plus loans for the PhD program, you could put them into repayment, but you have to communicate that to the financial aid office at school because the default is if you're enrolled in a program at least half time, they're going to default put your loans into what's called in-school deferment. And in-school deferment does not count as a status towards PSLF. We have to be formally in repayment. So that's something to know is yes, you could accrue credit towards PSLF if you're in a PhD program or if you just went back to school for something else, as long as you keep the loans that are not affiliated with that degree in repayment. And if you opt to forego the in-school deferment for the loans that are for that current program, if that makes sense. When can we expect the courts to decide the outcome on the SAVE plan? Man, great question. I would hope it'd be soon. I think over the summer, realistically, so closer to June, they're having a negotiated rulemaking happening like right now or over the next few months. So this, I think, is something that we'll have some resolution on by June of this year. So hopefully very soon. And then lastly, last question on here is if I founded a 501c3 and work for this nonprofit full time, does this still count for PSLF? And the answer is yes. So if you are working actively within that 501c3 that you've established and you have that 501c3 status, like the tax code is approved, then yes, this does count towards PSLF. You would have had to establish this with a couple board members that are not yourself. So you would have to have somebody else sign off on your employment certification form, not you. So that could be your secretary, vice president, whoever is also within the 501c3 with you that can prove, yes, you do work at least 30 hours a week for this nonprofit. Now, the key here, though, is you have to be an employee of the nonprofit. So you have to earn income from this nonprofit. It can't be just volunteer work. So that's the key there. All right. And here, one last question, and we'll move on to a couple other topics. Is it true that if you were working for a qualifying employer during COVID and were not required to make payments, that the $0 payment counts towards the qualifying payments for PSLF? And yes, that is true. So, COVID, from March 2020 to September 2023, we were in a what was called the COVID forbearance, where you were not required to make payments on your federal student loans. And the great part about that was the $0 payment counted towards PSLF as long as you were working full time at an eligible employer at that time. So that is true. You can go back and get credit for that. And what's great also is PSLF is retroactive credit. They're always going to look back at your prior payment history. So you would submit the employment certification form for that employer, which is done on the studentaid.gov website. So studentaid.gov is, I think, a really great website. Make sure you have access to it. That's where you do your PSLF forms. That's where you switch repayment plans, all of that good stuff. All right, so let's talk through. So we talked a little bit already actually about PSLF changes coming. So we talked about how there could be fewer IDR payment options because if they're going to take away save, then we may be left with IBR, pay, and ICR. I do want to talk about the worst case scenario though. Okay, so worst case scenario, what could happen is they decide they want to terminate the statute that made save possible. So it was brought about by an executive ruling, but it was made possible to be done that way through a specific statute. It's called the ICR statute. So ICR, income contingent repayment. This statute, what they're arguing is that it wasn't the intention for that statute to provide loan forgiveness at the end of the term of time, which is it's very interesting. It's a very convoluted conversation, but essentially what that means is if they decide that that statute was not meant to be, to encourage loan forgiveness, they could just waive that statute altogether or terminate it, and that would take away save. It's the fastest way to take away save, but the collateral damage is also going to take away pay and ICR. Those two plans were made possible through that ICR statute as well. So what that leaves us with is new and old IBR. So the good news here is that we still have an income driven plan. It could be as low as 10% of discretionary income. But the bad news is if we're an older borrower or we have older loans, then the payment calculation would be 15% instead of 10%. So that's the worst that can happen, but we do still have access to an income driven plan. We talked about how PSLF is still very safe because it was legislative, so I'm not too concerned about PSLF itself getting taken away. And then the save forbearance, we talked about how being in that save forbearance right now is harmful to PSLF because the forbearance is not counting towards your PSLF credit, and that might be something that you want to change. So the way to change that is to switch plans potentially. We'll talk a little bit more about that here coming up. So what happens if we're not going to be doing PSLF? Maybe we change careers later, or we're working in private sector, or we're working less than full time. Whatever the scenario, there is still income-driven repayment loan forgiveness, which is the 20 or 25-year timeline. This is an option if your balance is greater than your income. Mathematically, it might still make sense to do loan forgiveness, even though it might take us longer than PSLF. So, this forgiveness opportunity doesn't have any job requirement. Like, you don't have to be working a specific job. You could have no job at all. You could be a stay at home parent and still pursue loan forgiveness on this plan. We still have to have federal direct loans. We need to be on an income driven repayment plan. So we need to choose either the IBR plan, the pay plan, or ICR. And it will provide loan forgiveness if mathematically that's what we get to after making payments for 20 or 25 years, or the 240 or 300 months here. So this makes a lot of sense again for folks whose balances are large in comparison to their income, or will be large in comparison to their income in the future. The balance at the time of forgiveness could be taxable. So we talked a little bit about that earlier, how PSLF, the balance is not taxed. But if we do the longer term forgiveness without PSLF, the IRS sees a forgiven debt or a canceled debt as a benefit to you. So what they do then is they tax it. Of course, it's the IRS. So they take a look at that benefit, that loan cancellation, and they tax that amount as if you earned it as income in the year of forgiveness. So it's not something that you have to worry about now, but it is something that you have to prepare for and save for to be prepared to pay that tax bill in the future. So that is part of our planning. There's calculators on our website or online that can help you get an idea of how much would be forgiven. And that could be what helps you determine, okay, that's going to be the amount that they're going to consider as income that year for me. How much tax would I have to pay on that? And that would be based off of your tax rate, whatever that is in that year. One note too, just because I saw one of the questions in the chat. So if I currently make more than my balance and will continue to make more than my student loan balance, what is the best course of action since it seems that PSLF is not an option? So I would still run the numbers for yourself. I would, so there's some free calculators on the studentloanplanner.com website. So studentloanplanner.com. There's a PSLF payment calculator that you can take a look at where you can plug in your income, your balance, and it will give us an idea of if you pursued PSLF based on what your payment is per month, would you end up paying the loan off before getting to the forgiveness threshold or not? Is there still maybe a benefit to going the PSLF route because maybe a little bit of forgiveness is still there? That's what I would recommend doing, because the other thing you want to take into account is how much credit you already have towards PSLF. You might already have some credit. You're not looking at 10 years from now. Maybe you've been working there for 2 or 3 years and you've got some eligible history that means you only have, 7 or 6 years left, something like that. So that's what I would encourage you to do. One other question is, do full-time internships count towards PSLF? They could. They could if they're paid. So if you're considered an employee for an eligible employer, so if you're doing an internship at a school or at a hospital or anywhere, if it's paid and you're considered an employee, you're working full time, and you're making income driven payments on your plan, so that you would have to apply for an income driven plan and start making payments on your student loans. But if all those three things are existing at the same time, yes, it would be eligible. And then another question, should I consolidate my loans before my grace period ends since I graduate in May, or delay them? Great question. This is getting into some of my favorite stuff, which is like saving and being strategic and squeezing the most out of our plan. So if you are graduating here coming up in May, congratulations. That's awesome. I would recommend consolidating your loans post graduation. You're going to have to do they call it like a loan exit counseling, I think is what they call it. You're going to have to do that. And then you'll graduate, and your loans will go into the 6 month grace period. That's automatic post graduation. You go into that grace period. And the great part about the grace period is you don't have to pay during that time. But the downside to the grace period is that none of that time can count towards PSLF because we have to be in repayment to be eligible for PSLF. So I would suggest consolidation post graduation because it foregoes that grace period. Consolidation can be done on the studentaid.gov website. So that's combining the loans within the federal system. It's not privatizing them. Privatizing is totally different. That's taking that to like a private bank and trying to get a lower interest rate. That's not what we're doing here. You don't want to do that if you're doing PSLF. Consolidation just means combining the loans all together in the student loan system. So you have a direct consolidation loan to manage going forward. And that does a couple things. It waives the grace period so we can enter repayment sooner and start working towards PSLF sooner. It simplifies your loan situation. So instead of monitoring 12 different loans for loan forgiveness, you would just be monitoring the consolidation loan. So it really helps with simplification there. And then last, it's not pro or con, depending on how you look at it. It doesn't really change your interest rate. It gives you a weighted average of your existing interest rates, and so it's not better, but it's also not worse for your interest rate. But also the interest rate is less impactful or matters less if we're doing PSLF because we're trying to get as much forgiven as possible. All right, so IDR, if we're doing the longer term forgiveness, some of the changes coming are very similar to what we just talked about for the PSLF changes. But IDR changes are we potentially have fewer income driven repayment plans to choose from. So we talked about that. It's probably might just be IBR, pay, or ICR that we choose from. We're probably not going to have access to save. They had been waiving the taxability of student loan forgiveness, meaning we've seen a lot of people hit the 20 years or the 25 years of forgiveness and be eligible to get their balance forgiven. And they have waived this tax implication for those folks until next year, 2026. So, kind of interesting because we haven't actually seen someone pay that tax implication for the longer term forgiveness. It's supposed to kick back in next year. We'll see. We'll see what they do with the tax code. But that is something to take into account is that we probably want to plan on the balance getting forgiven being taxable, not PSLF, longer term forgiveness. There was an IDR account adjustment that happened. That's probably not super applicable to you guys. And then there may be a new income driven plan that they come out with, that Congress comes out with, but it may not have loan forgiveness. So if you're someone who the longer term loan forgiveness is probably not going to make sense because you'd pay the loans off before you got to 20 or 25 years, but you're also not maybe going to be eligible for PSLF for whatever reason. There could be another income driven plan to consider that does not have loan forgiveness. It's designed to pay your loan off within a 10-year window or sorry, basically it's what the total cost would have been if you paid the loan off within 10 years. So it kind of caps the total cost. That plan was a proposal. There's a couple other proposals going on. So the short answer there is there could be more plans that come out later that we can explore for folks doing loan forgiveness or not, for folks who are paying the loans back. So that's something to be aware of is that we could see some new things coming up. I would say, let's see, just one little note here. I would say that headlines are going to be pretty scary over the next year. Pretty dramatic. They're going to look pretty dramatic. It might scare you into thinking that PSLF is going away or that income driven repayment is going away altogether. There's a lot of things that could be said or that can happen in the news coming up that I would say headlines are a little dangerous to rely on. You want to, of course, like read the article, understand what the article is saying. Is it just cherry picking like one part of something that somebody said, or is it a legitimate worry? And I would say the best sources of truth when it comes to news on student loans would be the studentaid.gov website. And I will be biased and say I think our newsletter that we send out on Thursdays is really helpful because we break it down through the student loan planner newsletter to give you an idea of, hey, this is what is being talked about, this is what's legit, this is how to distinguish, if it's relevant to you or not. So I would sign up for our newsletter as well. It's free to give you some information on what's going on an ongoing basis, but also rely on the studentaid.gov website for official updates from the Department of Education. So we've talked a little bit about the SAVE lawsuit. It's an effort to block this new SAVE plan, and we think it most surely will be blocked coming up. It was highly unfavorable. The plan was to the Trump administration, and that was a goal for them to get this plan out of here, unfortunately. The good news is we still have IBR, we still have those other income driven plans right now, but that is something that we think is going to go away. You should only be on the save forbearance. So let's say you are in forbearance, you're in the save forbearance. It's different if you're in school. If you're in school and you're in the in-school deferment, that's a little different than this save forbearance. Save forbearance, you probably only want to be in if you are planning on paying the loans off, only because it's giving you 0% interest right now to be in that forbearance environment. But again, it's not counting towards loan forgiveness, so it's something that you'd want to maybe switch off of if you're trying to work towards PSLF. Let's see. Yeah, and this is kind of summing up what I just said. So IBR is a much better option if you qualify to make sure that you're getting forgiveness credit. IBR, so just a quick rundown again of what IBR is. So the cutoff date to be eligible for new IBR is that you could not have had loans before July 2014. This means if you're a new borrower as of July 2014, your payment on IBR would be based on 10% of discretionary income. If the loans are older than that, IBR would be 15% of discretionary income. Forgiveness timeline for PSLF is 10 years if we have perfect history. Doesn't have to be perfect though, doesn't have to be consecutive. It's just an aggregate number of payments while we qualify towards PSLF has to be at 120 months or 10 years. Forgiveness is 20 years on new IBR or 25 years on old IBR without PSLF. Taxes and marriage. Let's talk about that for a second. If we are on an income driven plan and we are married, let's say our spouse does not have student loans, your student loan payment is based on your income. How do they get that income? Well, they look at your most recently filed tax return. If you file taxes married jointly with your spouse, they are going to base the payment off of joint income. If we file taxes separately, so that's still filing married, but filing separate, so you each have your own tax return, this allows you to keep the payment off of just your own income. So that's oftentimes a strategy we're talking about to keep the payment as low as possible for folks pursuing loan forgiveness. If you and your spouse have student loans, then filing separately sometimes is not beneficial in that case because you're both going to have a payment anyways. And if we file jointly, what they do is they proportionalize the payment between each of you based on the household income. So if you've got 20% of the household debt for the student loans, then you'll get 20% of what the household student loan payment would be applied to your loans. That's how that would work. IBR does not have an interest subsidy or discount. That's subsidy is another word for discount. Interest does accrue over time if your required payment is less than interest. So this is why people's balances can grow being on an income-driven plan. Even though they're current, even though they're making the required payment, their balance could still be growing because if your payment is lower than what the interest cost is per month, your payment's going straight to interest, and then anything that's unpaid just keeps getting added to the balance. So we talked about how this plan is guaranteed in law, so there should not be any movement or threats against IBR. This plan should be available to us And new IBR is basically the same exact thing as the pay plan. So far, pay is untouched. That is something that we'll have to see over the next couple months if that remains the case. Okay, I'm going to check the chat real fast. Oh, yeah, thank you for putting the newsletter sign up in there. Let's see. Okay, and so someone asked a follow-up question, what should we not do? And I said simply just we should not be refinancing the student loans. So refinancing, if you're going towards loan forgiveness or PSLF, refinancing is when we privatize the student loans. We take them out of the federal system and we take them to a private bank like Discover or SoFi. If we do that, it's a permanent decision. We privatized the loans, we took them out of the federal system. Private loans are not eligible for PSLF. They're not eligible for income driven repayment plans. So you don't want to do that if you're planning on pursuing loan forgiveness. That's one of the biggest mistakes I see. So definitely don't refinance. Consolidation is different. When I say consolidation to me, that means combining the loans within the federal system. Okay, so what should you do now? Most borrowers, a lot of folks should still be in school, I think, listening in on this conversation. So you haven't even had the chance to apply for a repayment plan yet. And that's fine. That's a fine place to be in because you can get it right from the get-go. Um, when you graduate, I'd probably suggest consolidation. So that's combining the loans post-graduation, and it forgoes that grace period so you can enter repayment sooner rather than later to start accruing your PSLF credit. This is assuming that you will have a PSLF eligible job soon after graduation. So that's what I would suggest there. And in that consolidation application, you can apply for an income driven repayment plan. You probably want to apply for IBR or pay, whichever one is better for you, or whichever one you're eligible for, I should say, that gives you the 10% payment calculation. And then let's see. We shouldn't be applying for save at this point because we don't think that that plan is going to last. And if you apply for save, you're just going to be put into forbearance that's not going to count towards PSLF. If we're pursuing PSLF, make sure to submit an employment certification form. So do that now for your current employer or for your future employer here coming up, but also do that if you've had any prior employment at the same time of you making student loan payments. So both of those things have to be true for it to make sense to submit an employment certification form. We had to have been working in public service, but also making payments on student loans in the past. So if you went to school, got a degree, made some payments for a couple years while working at a school or working for the government somewhere or for a nonprofit, go ahead and submit a PSLF form for that credit because those loans that you had at the time could accrue some PSLF credit towards the 120 payments. So that makes sense to do. If you're brand new to this, you've been going straight through school, don't worry about any past history because we weren't in repayment previously. Just make sure to submit your employment certification for your current employer or the future employer you're about to have. All right, number 3. Double check if your payment history is correct. So the great thing is in the studentaid.gov website, there is a PSLF payment tracker. This is a very transparent way to make sure that they're tracking the payments correctly for you over time towards PSLF. And it itemizes the months that it's giving you credit for and that it's not giving you credit for. So that's great because you can catch problems sooner rather than later to get them fixed. There's also a payment tracker for the longer term forgiveness as well. It's also on the studentaid.gov dashboard. Oops, skip that one. And then lastly, let's see, get a backup plan. So I think we're talking about being proactive and probably assuming we're going to go on the IBR plan. So I would say get your plan A in place and get your plan B in place, just in case maybe they take away pay or they take away that ICR plan. But get your plan A and plan B in place to give you some peace of mind and knowing what your student loan plan is going to look like, best case and worst case scenario. All right, I'll pause. So, best banks to consolidate with. So, remember, if we're using the term consolidate, I would say that's combining the loans within the federal system. So that means that we're combining things, we're keeping them federal, we're going towards PSLF. If we're privatizing the loans because we're going away from PSLF, we're not doing PSLF, we're not doing an income driven plan. That's the term I would use here is refinancing. So I'd put that in the chat. So refinancing is privatizing the loans. That's committing to paying the loans off. There are banks out there that you could consider refinancing with. Our website, we do a search of the most common student loan refinancing companies out there that we track rates for. So check that out on studentloanplanner.com. But there is like SoFi, there's Citibank, there's Laurel Road. There's a couple other options like Credible, Splash, a few others. But if you're privatizing the loans and committing to paying the loans off, you just want to get the lowest interest rate. That's really the goal there. But I will say that's my first mistake here. So the five most common student loan mistakes I see is folks go and refinance when they shouldn't. So again, refinancing is committing to paying the loans off, committing to not doing PSLF, and not needing an income driven plan. But if that's you, if your plan is to pay the loans off as soon as possible, then go for it. Go and refinance. Just know it's a permanent decision. Number two, most common student loan mistakes I see is putting off big life goals because of your student loans. I see this a lot, unfortunately. I have folks, put off getting married or having kids or starting a job, switching jobs because of their student loans. I strongly believe that if you have the right student loan in place and you know how to pivot that plan uh, against, what you want to do with your life, that's going to put you in a very good position to not feel like you need to put off big goals, financial goals, or life goals. So have the right game plan for your student loans. Don't let them dictate your financial future or your career path. Have you do that. You dictate what your goals are in life and what you want to do for your career, and then your student loan plan can follow. So that's the order it should be in there. Third most common mistake I see is not having complete or perfect information about forgiveness options. There's a lot of misconceptions about loan forgiveness. You want to make sure if that's the path that you're going, you're crossing your T's, you're dotting your I's, you know exactly that you're doing the right things so that there's no surprises. And I think we did a good job of covering how to be eligible and making sure you submit documentation for PSLF and everything. But that is something you want to do on an ongoing basis with your plan is revisit that, make sure you're still in compliance with the plan, you're still getting all the benefits that you can. Fourth common mistake I see is just missing out on loopholes. So those are those sneaky little ways that you can save money. So filing a tax return the year before you graduate. So if you're in school, you're about to graduate, let's say maybe you didn't make any income last year. I would still suggest filing a tax return, even if you didn't make much income or you're not required. Reason being is when you apply for an income driven plan, it's going to go off of the most recently filed tax return to base your payment off of. So if your most recently filed tax return shows that you didn't make very much income, your payment can legitimately be $0 for the first year. And that counts towards PSLF if you're starting to work at a PSLF eligible employer because you don't have to update your income but every 12 months. And it's always based off of the most recently filed tax return or current income, whichever is better. And of course, the lower the income, the better. So that's a loophole right there. File a tax return before you graduate to get the first year of your payment really low. Another loophole is filing taxes married separately if you're married to keep the payment off of just your own income. Another would be contributing to retirement accounts like your 403b or 457, something that's pre tax. That means we're deferring money to retirement. We're reducing our adjusted gross income, which is what the student loan payment is based off of. So there's a lot of little ways that we could save some money on our student loan plan if we just knew those loopholes or those strategies. Our newsletter will help you with some of those, and then our blogs on our website can help with some of that stuff too. And then lastly, the most common mistake I see is just not committing to either being really passive with the loans and going towards loan forgiveness or being really aggressive, paying as fast as we can, reducing that interest cost over time. We want to be going one route or the other, committing to one way or the other, because it mathematically does not make sense to be going towards PSLF, going towards loan forgiveness, but paying extra on our loans. Don't do that. Why would we do that? We want to pay as little as possible on our loans, pay what we're required to, right? And maximize how much we get forgiven if we're doing the forgiveness path. So commit to one way or the other. Let me take a look at some questions. Let's see. Does it mean your return status will be single if you're filing separately when you're married? So no, it would be still married, but specifically you're filing married, filing separately. So it's a tax status. Don't file single because you are in fact married. It's married filing separately. Good question though. Q&A. I'm going to go take a look at that. And then I'll just put this up here. This is our free calculator that you could download or take a look at to help you with some of these calculations for your income and your student loan balance. If we have a PSLF eligible employer internship this summer while we're still students, do you recommend making payments towards PSLF for these 2 to 3 months? I would probably say no because your loans are going to be in the in-school deferment status if you're still in school, like you go back to school in the fall. The problem with getting in and out of in-school deferment is it's not very fast because we're relying on the school to change the status with the Department of Ed, and the Department of Ed has to change the status with your servicer. So it could take 2 to 3 months to get you out of in-school deferment for you to make payments, but by then maybe you're done with the internship. So I'd probably say no, it's not worth it. I would simply focus on the internship, focus on getting through school, and then maximize your PSLF eligibility after you graduate. How often do you need to submit a PSLF employment verification form? Is it yearly? There's actually no requirement on how often you need to submit it. I recommend submitting it once a year, though. I think yearly is a good practice because it's a great way to make sure that they're counting up your payments appropriately. And like I mentioned, you're catching any problems sooner rather than later. Great questions. Let's see. So we talked about how, SLP Wealth or Student Loan Planner, we do student loan consultations. So if you need some one-on-one help with this, that is exactly what we do. Come check us out. We have a bunch of free student loan resources on our website as well. Calculators, blogs. We have a podcast if you want to listen to us talk about student loan stuff. We have a YouTube channel where we talk about student loan stuff and break news about what's going on. So there are a lot of different avenues you can keep yourself updated on what's going on, and free, a lot of free resources. But if you do need some one-on-one help, we do offer one-on-one consultations, 1 hour session to really dive into your specific student loan situation, figure out what plan you should be on, what tax status you should do if you're married, do the math on how much loan forgiveness you could potentially get. This is a $100 off discount code for folks who are listening in today. I'll pull this back up here in a second, and actually I think it's right here. But these are the other resources I mentioned. So the studentloanplanner.com calculator, the Student Loan Planner podcast that we've got, and studentaid.gov is also worth mentioning. I'm going to put that in the chat. That is the source of truth for your loan information and where you would log in to do a lot of the things we talked about, like apply for PSLF, apply for consolidation, or income-driven repayment plans. So that's a great website to have access to. But thank you guys so much for having me. I know we're coming up on time. If there are any other questions, I'm happy to answer any more. I think we've got like 2 minutes left, but I'll pause.
No more questions in the chat box and the Q&A box, but thank you so much, Megan. This was an incredible presentation. I learned so much, and I know our students are going to find so many resources in your presentation. So thank you so much.
Yeah. Thank you.
We don't,
Thanks for having me. And sorry if my dogs were in the background being rowdy. You probably saw them run all the way around, so maybe it was a little entertaining.
no worries. And I think we will go ahead and end the presentation now. If you can just stay back for a little while, Megan.
Okay, yeah, I can.